Hi and welcome to our study today. We continue with our discussion on money, and in our last lesson we discussed demand of money, and we defined demand of money as the tendency or the desire by individuals or firms to hold on to money rather than spending it. And we looked at different motives why individuals would do that. Today we will proceed to another subtopic, which is supply of money. Supply of money. Remember, under supply analysis, we defined supply as the willingness and the ability by the sellers to provide goods to the market at a given price at a specific time. So that is the general definition of supply. Now, when we define supply in relation to money, it will not be different. It won't be different, because supply of money would refer to the stock of money items that are in circulation in an economy at a particular point in time. Supply of money refers to the stock of monetary items that are in circulation in an economy at a particular point in time. And these monetary items consist of total currency, that is the notes and coins that are issued by the central bank, and also the total demand deposits. The total demand deposits being the deposits by individuals and firms in commercial banks that are withdrawable on demand. So monetary items. It is the total monetary items that are supplied in the economy at any given point in time. And these are the coins, currency notes, and coins, and demand deposits that are available or can be withdrawn at any given point in time. So supply of money is the money that is in supply in the economy at any given point in time, and these monetary items would include the currency notes, the coins, and demand deposits. These are deposits that are made into the banks by people or firms, because that money is withdrawable at any point in time. It's only that instead of having the money in your pocket, you decide to take it to the bank for safe keeping. Otherwise, it's still just your money. So that will comprise the monetary items, and supply of money being what is in the economy at any given point in time. Okay? So an increase in money supply would therefore be as a result of either increased issue of currency by central bank or increased credit by commercial banks. So if you are to have an increase in supply of money, then it can only happen when the central bank prints more currency notes and coins. Central bank, okay, more central bank, or where the banks demand deposits, or where the commercial banks offers loans to individuals. Okay? When currency notes are printed by the central bank, that will lead to an increase in the supply of money. So it can increase by either the central bank issuing more currency notes or increased credit by commercial banks when you go to the bank and take out that money. It means that now you are bringing money into the economy, because again, banks offer loans, and banks offer loans sometimes out of deposits of other customers. If you go to the bank and take money in form of loan, then you are basically, the bank is basically giving you money, and part of money will comprise the deposits that were made into the bank in the past. So that is what we refer to as the supply of money. Supply of money. So supply of money, supply of money includes deposits from individuals and firms which are held by commercial banks. Such deposits are offered as loans to other people at an interest. The deposits in the commercial banks therefore end up increasing the money in circulation in an economy, increasing the supply of money in an economy. Then we can briefly discuss the factors influencing the amount of money in circulation. Factors influencing the amount of money in circulation. Number one, government policies. Government policies. The amount of money in circulation is mainly dependent on policies adopted by the government. If there is too much money in circulation in the economy, the government will institute measures that will reduce the money supply. The government, for example, may issue treasury bills to mop up excess money it may consider to circulate in the economy, thus reducing money supply. On the other hand, if there is too little money circulating so that economic activities are hampered, the government will institute measures that will increase money supply in the economy to increase economic activity. As such, the government may buy back treasury bills to increase the amount of money in circulation in the economy. So, factors that will influence the level of monetary items in the economy, we are saying government policy. If it comes to the knowledge of the government that there is too little money in circulation, or if there is a lot of money in circulation, if there is a lot of money in circulation, by now I know you understand that may not be good to the economy. Because when there is a lot of money in the economy, that will lead to high rate of inflation. And with high rate of inflation, that would mean that there is a lot of money chasing few goods. People have money, but there are few goods to buy. So that may not be good for the economy. So the government may decide to sell treasury bills so that people bring money to the government and they take these bills or bonds. Okay? So when treasury bills are offered to the public or to firms, then they will lead to supply of money in the economy, because you take money from your account, from your deposit, from the bank, your bank, then you take that money to the government. That is in case of high supply of money in the economy. If there is low circulation of money in the economy, the government will do the reverse. The government will sell the government will reissue, okay? The government will sell, will buy back, the government will buy back, okay? Will buy back the treasury bills. It's like redeeming. The government will redeem the treasury bills. When buying, it means the government is giving individuals or firms money and they take back the treasury bills. See, it's that simple. Okay, it's very simple. When we say buying, it's very simple. So that is how it is done. And I think I should illustrate. Now assume this one is a treasury bill. Okay? I'm the government. I'm the government and I offer treasury bills. TB. I have many of them. I'm the government and you are the public. You are Raia. I'm the government. You are a company. Okay? And there is a lot of money in circulation which is affecting your businesses. Okay? Is affecting your businesses. So as a government, we put in place policies. We may decide that now that there's a lot of money in the economy, so what we do, we sell these treasury bills. Give you the treasury bill and give us the money. So you see, money is now coming from the economy to the government. Then you take the treasury bills. So that one will reduce the amount, the supply of money in the economy. So you will go to your bank, withdraw here where you deposited. Withdraw money, come and buy this treasury bill. So that is what will happen when there is a lot of money in the economy. But when there is little money in the economy, now since you had the treasury bills and I had your money, so I return the money to you. That means increasing the supply of money in the economy, then take back the treasury bill. So that is one way in which there can be, the amount of money in the economy can be influenced. Factors influencing the amount of money in circulation. Government policies. Then number 2, the policies of commercial banks. The activities of commercial banks with regard to lending have an influence on the overall money supply in the economy. If the commercial banks offer more loans to individuals and firms, more money is released into circulation, thus increasing money supply. If, on the other hand, commercial banks offer fewer loans, money supply decreases. So it is the same concept. But in the first case is the government offering money. On the other hand is the commercial banks. The policies of the commercial banks. All right? If the commercial banks offer more loans to individuals and firms, more money is released into circulation, thus increasing money supply. That is straightforward. On the other hand, if commercial banks offer fewer loans, money supply decreases. There are times when when you go to the bank tells you are not offering loans for their own reasons. It could be that maybe the interest rates are low. Like at the point of recording this video, the bank has put a cap on the rate of interest that banks can charge on loans at 14%. So at the moment, some banks are are not offering loans, okay, because the rate of interest is low. And remember, it has gone down from 24%.